I'm Keith McCullough, and welcome to The Pitch. All right, this is a relatively new format where you get to have a look-see inside of the process and how I work with my teammates. So we're going to have 6 analysts with 6 ideas in 60 minutes. If they go past the 7 or 8 minute mark, it's not like they get dunked into a tank or anything like that, but they probably get cut off onto the next person. So they're going to keep it tight. I might have time for a question or two with each analyst, depending on how tight they keep it. But let's get on with it. We have Ami Joseph, who's obviously no stranger to Hedgeye. He's certainly not a rookie. Partner at Hedgeye, fully loaded, but he's got his new Tech Pro product. So many of you know him through that now. Thank you for subscribing to that. And Ami, you're on deck, man. You get to lead us off.
What's up, Keith? Well, today we've got Zendesk for you, where we're going to be taking you through our idea on Zendesk. And if we look at the first slide, you can see our cartoon, you can see our title. Essentially, Zendesk is getting a second lease on life over the last year. So, and that is like, basically, if you boil it down to one thing, that's the one thing. Second lease on life, on adoption curve, a re-accelerated adoption curve. So if you look at slide 2 as our thesis, you can read it afterwards. But just to give you the quick hits on this one, Zendesk is a company that provides software for the customer support and ticketing world. So every agent in customer support needs to have some kind of ticketing software to track and monitor issues that come through so that the issues can be resolved. And basically any company that has customers has to have some kind of customer support software. Zendesk has been extremely strong in the category that is, let's say, greater than 100 employees and less than 10,000 employees. That's been their real bread and butter, their strongest area. They've also been very strong in the area of companies who are digital commerce native. So that is a very strong category for them. We looked at Zendesk a year ago. We went long in July because on a lag from the start of COVID, they had what we saw was a massive increase in the data to the point where, and we're going to show it to you, to the point where we thought maybe our data was wrong. And we backed that up with field notes, field checks, which we did with that surveyed the landscape of users and professional service installers, meaning people who do the upgrades, the customization, that kind of thing, to see what was happening. And they literally fit hand in glove. We've done a few rounds of those checks, and I'm going to take you through that. So that all looks positive. And then basically, if I translate all of that through to Zendesk, the growth rate for this year is going to be much stronger than Street. And as the software world has gone, if you are growing faster than what people think, your multiple will also go up. Let's go and look at the data real quick. If you look at slide 3, this data comes from our HTED, which is an ecosystem data tracker that we have for the entire universe of software stocks that we track. And our pro subscribers get access to this. It comes out every month, and actually the new one is going to be coming out tomorrow. And this is the refreshed and actual Zendesk data that we show. And so you can see that the way this ecosystem tracker works is if someone's looking to hire someone with a Zendesk skill set, right? So it's not just Zendesk hiring. That's actually a fraction of what this tracks. It's also that the customers of Zendesk now also, every time they buy from Zendesk, they need to hire somebody internally who has skills in order to use this program, the software. And then the partner channels and the installers and the service installers and the value-added resellers, everybody has to hire somebody with a Zendesk qualification on their resume. And so that's what we're tracking, is the entire ecosystem growth. So you could see that in the COVID, it fell. This whole ecosystem fell. It gradually recovered, and it has taken off more recently. So you can see that's actually quite bullish. If you go to the next slide, this also comes from our HTED tracker. This is our HubSpot customer activity monitor, and this basically is tracking small customers who are sub 100 or sub 500, in employees. So there is a healthy overlap with the Zendesk customer base. And if you look at the yellow line on the left-hand side, that is support ticketing volumes. That's very bullish for Zendesk to the extent that this is a good overlap, there's a good read-through. So again, this is from our HTED. If we go to the next slide, on slide 5, this is app downloads for support, basically support software downloads for Zendesk, the core of the business. They have multiple products, but this is kind of like the meat of what you buy when you buy from Zendesk. And this has also inflected positively, and you can see continues to have a positive rate of downloads. That's another good momentum data indicator. If you go to the next slide, slide 6, you can see what we saw originally in July was that first bar pop. So out of nowhere, right? You're going from a few, this is sites added per quarter or per month. We track both using Zendesk software. This happens to be per quarter on the left-hand side, right? And when we saw this, we were like, this has to be wrong, right? This site addition number, and this tracks usually towards customer additions. We have to obviously massage the data and so on and so forth. It looks a little bit more like the one on the right than the one on the left, but the one on the left measures like an overall adoption, and then real like paid one, the kind of thing that you can actually see moving the stock, moving the model is the one on the right. But when we see the one happen on the left, out of nowhere, we were like, oh my God, this has to be an error. And we went out and we did field checks. We spoke to, as I mentioned before, we did that in July. We did it again in October. We did it again in February of 2021. And I just want to read you from our most recent February 2021 field notes. Okay, we presented this on our March 1st HT3, which is again another product where we put out current data on all of our active names and sometimes even some of our bench names. And this is also something that our pro subscribers get. I just want to read you a quote from one of the field notes. One of the people said, okay, as I enter March 2021, my level of business is higher than December 2020. Okay, this was our question. He wrote, I was happy with where my existing book of business was as of the first of the year. And in 2 months, I have doubled my expected revenue for 2021. Bananas. That's a quote from a Zendesk installer, professional services, custom software creator. Lastly, if you go to slide 7, this is translating all of that to the customer curve. You can see this is the adoption curve. This is like new customers rolling on to the Zendesk platform. And when we take this and we translate it to the model, we see better backlog numbers. Like if we just used, dollar per customer for backlog additions, if we do the same thing for billings, all of that, what that translates to for us is, I'm going to say something crazy here. We're at 40% year over year revenue growth for Zendesk in 2021. The street's at 2020. The street is at 26%. Now, I don't know if we're mismodeling something and maybe we won't get 40%, but we're going to get better than 35%. And the street's at 26%. So this is one where I think the numbers and the data are so good that even if people want to argue that Zendesk should trade at a discount, this, that, or the other, the stock should be over $200. That's kind of it from me on Zendesk.
I like that. Pod 1 acceleration, for those of you that speak Hedgeye Nation speak, revenue acceleration and ahead of expectations. On that, I was looking at the shareholder list, Ami. When you talk to institutions, the top 10, top 20 list is really just decorated with the Boston or Baltimore, T. Rowe Price, Fido, BlackRock. It's not a hedge fund hotel on the long side. In fact, there's 6% short interest.
Yeah, I think it's I think that there are some pushback from the hedge fund community, which we understand. It is mostly a one-trick pony, right? So this is one category, one product, basically software company. They've tried to expand into other categories, but they're still very small in all of those areas. And then the other thing is it's a fairly well-penetrated category of software. So, there's the last year, a year ago before COVID, the C10 was something like 7.5 million seats for this kind of software. And basically, if you add up the numbers of all the providers, there are 7.5 million providers, 7.5 million seats split among those vendors. But the area has received a lot more attention over the last 18 months because in digital commerce, the customer support person is the only interface between you, the buyer, at retail, e-commerce, and the company. Whereas in normal retail environments, right, you've got the teller, you've got somebody, a store clerk, you've got somebody walking around helping you to buy something. This is the only person. So there's a higher ratio of dollars of sale to customer support vendor in an e-commerce environment than there is in traditional commerce. So this whole space has gotten a new lease on life. And everyone who didn't have a support software before because they were too small and they were basically just using like an inbox for, everybody troubleshooting the thing together, those companies have grown more complex, their sales have gotten bigger, and they need more sophisticated software, and Zendesk is right in that zone.
Well, thank you for explaining that, Tess, because I, as a technology neophyte, needed it, and I like the setup across the board quantitatively, so that looks great. So that's a good example of an analyst keeping it tight. We're going to keep each of these to less than 10 minutes. Up next is also new to our to our pro product. It's actually called Unplug. Emily Evans, who is live from Tennessee. Welcome.
Thank you, Keith. I'm going to talk about your favorite subject today. As you know, I'm a policy analyst, not a fundamental analyst, but I want to talk about inflation and the effects it has on that part of healthcare that is basically a spread business. And as we all know, healthcare inflation is never great if you're in a spread business. And specifically, I want to talk about one of the big hospital companies, which is Universal Health System, which is one of the weaker sisters of the group, which includes Tenet and HCA. On the one hand, UHS has that's on slide 3. It's losing customers, and I'll explain why in a minute. And on the other, it's facing higher labor costs. Labor costs in healthcare, like everywhere else, have gone up, especially low-wage earners who happen to populate the behavioral health the behavioral health part of the system, which is, of course, about 45% of UHS's business. The other general medical hospitals, those are seeing inflation go up pretty significantly on the wage business. The problem is on slide 4 is their payments are generally predetermined through contracts with the federal government, sometimes as long as 18 months in advance. So as their wage expense goes up, the reimbursement really has trouble keeping up and they get squeezed. Now, if they're particularly good at managing their business, in slide 5, you can see HCA is on the right, and there is probably nobody better in the hospital business, or I would venture to say the healthcare business that is better at managing its costs than HCA. HCA and I'll talk about this in a minute, is actually getting vertically integrated into labor. It owns a nursing school. It is essentially funding a medical school here in Nashville, and has refined their ability to manage that cost, probably like nobody else in the industry. But if you look at what UHS has experienced over the last few years, the labor costs are a lot more variable. They have a lot less control, and they particularly have a lot less control on the behavioral health side right now, because they have they're low wage earners and they have options. And one of those options, of course, is to not work, because the equivalent of the unemployment insurance plus the state contribution works out to about $15 an hour. $15 an hour is, at the low end of the average for behavioral health, but it's way below what general medical surgical hospitals pay, because they tend to be much higher payers. And the reason for that, of course, is nobody really wants to work at a behavioral health institution, especially an inpatient. Another macro factor, policy factor that's been driving UHS's experience here post-COVID is that a lot of their customer acquisition comes through emergency rooms. Emergency room visits are down dramatically. If you go to the next slide, Eric, they're down dramatically. This is from a call that we did, Tom and I did a few weeks ago with Wellnessity. You can see, and it's sticking, and there may be a permanent behavioral change going on here when it comes to emergency rooms. Very typical inpatient psych visit, comes to the emergency room, is evaluated, and then leaves the hospital and goes to a behavioral health institution on an inpatient basis. If those people aren't showing up in the emergency room, they're not ending up in the inpatient psych facility. And that is going to continue, we believe, and if you listen to our call with John Quinn at Wellnessity, that's probably a permanent change in behavior. And one of the contributing factors to that is, if you look at slide 7, over the last few months, and this has really been ongoing for a while, you have just seen an explosion of alternatives in the behavioral health space. Talkspace, which is being SPAC. Teladoc, of course, has had, and Tom has done a great work talking about how this is that particular part of their business has exploded. In other words, people are getting treated and they're getting help before they ever crash into an emergency room, like never before. We have never seen this level of behavioral health and psychology and psychiatry being delivered in the United States, and most of it virtually and over the phone. It's also a system that has operated a lot outside the reimbursement system, a lot outside the regulatory system. So its ability to grow and expand across the country and into all kinds of population groups is very different. Now, there's lots of risks to this, and this is another policy issue, and that is that there's piles of cash still in the healthcare system that gives, and we've already seen Tenet do a big acquisition, HCA buying the hospice and home health unit of Brookdale, probably more to come. They're getting into PPE investments as well. So there is an opportunity for acquisitions with all this money sitting around to get UHS and other weaker units in the hospital system out of the box. But this is the pile. This is the pile of cash, and that's it. That's what I got.
What about the dynamics of the management team? I mean, Alan Miller founded the company a long time ago. He's 83 years old. I think last year or at least announced he was stepping down as the CEO. You know, is that timing just due to the timing of life, or is there a little bit more going on here?
I'm sure, he's 83 years old. He's been around forever. I think one of the challenges for any hospital leader, whether they're leading a company or just a hospital, is that they have always done what they've always done, and they're not terribly good at adapting. We used to actually say this about HCA, but the things I've seen them do over the last year and a half have made me have changed my mind. Sam Hazen's a great hospital leader, and he has great hospital leaders behind him. I think, though, that what you're speaking to is that ability to adapt in this environment. There's just no signs of it. There's no signs that they're going to innovate and adapt in a telemedicine behavioral health environment, and with labor costs, going through the ceiling over which they don't seem to have much control.
Yeah, I mean, there's nothing worse than having your actual costs go up at the same time that you're getting squeezed competitively on the cost side and with technology and a company that hasn't had an ability to change. I mean, that to me is, I got it. What is actually really interesting is that not a lot of short sellers get it. I mean, the stock's only got just inside of 2% short interest, so it's not everyone's favorite short. So now I'm quite interested. Thank you for that. I appreciate the, we call that pod 2 squeeze. Pod 1 is revenues. Pod 2 is your margins. So when your margins are going the wrong way, that's bad. And that's what short sellers, evil doers like me, look for. I'm kidding, obviously. Brian McGough, we're going to bring in, you don't get the back cleanup today, okay? You have to go third. So I know
I'll get over it.
You've been hot, but now small caps are correcting, Brian. I think people are starting to write you off a little bit. Have you run out of small cap, mid cap ideas?
Well, I have in PLBY, PLBY.
Oh,
PLBY group, which is a new best idea of ours. And I'll tell you, the stock raced off as soon as we put this name out a week and a half ago. It's had 3 bad days now. So now everyone's saying, oh, you're wrong. I think it's an amazing buying opportunity. So I really liked Ami's point where he said that his company had a new lease on life. This company has a new lease on life. Basically, what you got to do is have to think about it as a 68-year-old startup. This is a brand that's historically been very counterculture, very socially divisive, talked about, gay rights, legalizing drugs, segregation, LGBTQ rights. I hope I got that right. And of course, sexual wellness. And those things can be very taboo. There was about a 20-year time period where Hugh Hefner wanted to turn this into a media company. And that's when there's a certain generation out there that has a natural bias against this company because it thinks it's a magazine. It's not a magazine. There's no magazine anymore. There's no magazine. There's, no Skinamax channel that they got on next to HBO. It is a consumer goods company. So I want to walk you through a couple of reasons why I think you really get paid on this company. If you flip to slide 23, this is what initially hooked me on this company. PLBY has $3 billion worth of goods out there right now with the PLBY bunny on it. 2.7 billion of that is in style and apparel. 1.5 billion of that is in China. It just signed a JV in India, which could be as big as China. There's no reason why it can't. But $3 billion in total revenue, but only $61 million that shows up on its P&L. The point is, the rate of royalty on that is 2%. That's the lowest I've ever seen in my career. As I look at royalties, basically it's in between 6 and 12 is where you want to end up. And this company couldn't renegotiate any of these bad Hugh Hefner deals until he died. He died in 2017. New management team comes in. These guys are rock stars. Spoke with them yesterday again. And they've been working on renegotiating these licensing arrangements. Over a 5-year time period, they have an EBITDA target of $100 million, which is pathetic. It's a joke. They're going to blow through that in the worst way. The street's even discounting it, which I don't even get. But just by doing a renegotiation of the royalties that they're currently running on their existing base of business, which is already out there. This is a brand that's got 97% unaided awareness. I think I just tried blending a couple of words. It's a very stable book of business. They just have to get incrementally more cents on the dollar, and they've been renegotiating those. And I think that you win alone just by that getting done. The India JV is another big win. So that's point one. Point two is on the next slide, is what this company is moving on to. They're going into category expansion. There are 4 key categories. One is style and apparel, which is where they currently are. It's a $1.9 trillion market. They've currently got 2.7 billion of that. They're going to be doing women's wear, men's wear, geared towards a younger audience. This brand actually doesn't have any of the negative baggage that you might think with a younger audience. I've got a picture of that on this next slide, but don't flip yet. All right, flip. There's Bella Hadid wearing a PLBY bikini. So style and apparel, 1 big growth engine for them. 2, sexual wellness. This is when the conversation starts getting complicated. I got to talk about condoms, lubricants, bedroom toys, and I could keep going on and start getting in trouble here. But the fact of the matter is, this is a $380 billion industry, and there's no category leader. If there was any category leader on the planet that was destined to actually get a dominant market share in this category, it's PLBY, and they're going after that. Next category is beauty and grooming. They're going to come out with a cosmetics line. They've got a couple of brands, so it won't all be the PLBY brand. They've got, I won't walk you through what the other brands are, but the fact of the matter is they can go by tiering of product lines, which I definitely like, having sub-brands. This is a $400 billion category. You do have certain category leaders here, but where they plan on going with their product lines, this won't be licensed. They're going to do it, just like straight out of their own P&L and balance sheet. It's something that I think is a huge opportunity. Last opportunity here is gaming and lifestyle. They used to have these PLBY clubs, which were terrible. They just didn't work. That was Hefner's pipe dream. But now they brought back the Big Bunny Jet. Just years down the road, I think these guys are going to go the same way that the Hard Rock went, where it's going to have property on or off of the strip, and it's going to be serving regions and serving consumers with a certain type of lifestyle experience in the hospitality industry. So you got these 4 pillars here, each of which have a huge TAM, several of which have no category leadership, and PLBY, I think, is just ripe to really take that audience. If you go to the next slide, which we teased already, this is, it was taken a week ago, Bella Hadid. You could see that little Playboy bunny on her bathing suit. Almost slipped up there. You go to the next slide. This is the third way you get paid here, which is NFTs. Not in my estimates. It's not in my model, but this is a company that's got 68 years worth of artwork, images, both that made it into its magazine and that didn't make it into its magazine. As NFTs actually gain some traction, I was skeptical of this initially, started doing research on it. I'm starting to buy into it, but it's still not in my model. And if you go and you take a look at our model, which is on the next slide, you can just see that we are worlds ahead of the consensus. If you look at the tail estimate here, I'm at $1.26 billion in revenue. The consensus is at 322 million. I have never been that far off on my model with any company I've ever covered in 27 years. If you look, the street is at like $320 million in EBITDA, or I'm sorry, I'm at $328 million in EBITDA. My EBITDA number is above the consensus revenue number, which is just staggering. I've got them doing close to $6 a share in earnings over the course of year 5. This is definitely a tail call. The street's at $1.44. I think they're going to smoke estimates. They're going to beat, raise, beat, raise, beat, raise. Is it going to be a linear move? No. Are they going to screw up every once in a while? Of course they will. This is a big generational play. I don't think I've got as much upside on a stock as with this as since I did the RH call. And that was a call at $30, and now that stock's over $600. So I really think this is a really big idea. I'm going to have to convert a lot of naysayers on this one. We're going to have a black book out on this in a couple of weeks. My gut tells me it'll be our best viewed black book ever. And I put a 25 EBITDA multiple on where I am relative to the street. The street's at 90 million in EBITDA. I'm at 328 million. I get to a $250 stock, and it's now at $33. So big call here on PLBY.
I mean, this is going to be your best black book ever for a lot of reasons. Let's just be clear. It's going to be, I didn't know what the hell an NFT was until I just looked it up. A non-fungible token. How about that? How about that? Yeah. Now we're talking. Now we're talking. So what? Just one very basic question. You talked to management last night, and obviously, they can't legally tell you one way or the other. But I mean, I'm assuming you told them what you just said to all of us, which is I've never had such a gap against consensus on my cash flow estimates. Like what's going on here?
Yeah, I mean, they appreciate that we take a tail view on this. Most analysts don't really do that. And I was like, guys, you left great high-paying jobs in order to come over to this company. It's a $1 billion company right now. You couldn't have been joining for a $5 billion opportunity or even a $10 billion opportunity. And my price target's valuing this as a $10 billion entity. And the guy just looked at me and he was like, higher. So
what is it? There's what? Is it brothers or what? They're both names Liu. Do I have that right?
No. Ben Cohn is the CEO.
Okay, I'm looking on the shareholder list. There are two Lius that are on that shareholder list, alongside Fortress and Rizvi Traverse. Owns over 20%.
Yes, that's the private equity firm who took it private back in 2011. Yet they were hamstrung. They couldn't do anything until Hef got out of the picture, and Hef didn't die until 17. So they were just sitting on their hands doing nothing because Hef got in the way.
Yeah, that's a very dynamic component to it as well. And when you get change of control, you get rebranding, you get renegotiation of royalty rights. A lot of good work here, Brian. You are on a roll, man. Thank you for your very creative idea flow, and I'm sure everybody else is going to thank you too. Tom, you're up next. Tom Tobin.
All right, Keith. So I'm going to just cover really quickly, just based on some recent updates of some data, long that we have on the list. We haven't talked about it an awful lot, but EYE, it's a National Vision Center. They basically sell eyewear, and then it's essentially a COVID comp positive. The first couple of slides give you just a little bit of the backdrop here in terms of who they are, where they come from. One of the reasons we've picked this up is as we were looking at where medical care had essentially been deferred and delayed, and where acuity, your vision continues to deteriorate over time, where people are going to have to come back. We saw a lot of evidence of that in dental and vision, and a number of other places like, colonoscopy, for instance. There's a number of years of volume that's going to have to come back. So on our thesis summary slide, you can see, the first part is a return to in-person care, which has kind of already happened. I mean, what we're hearing a lot lately is sort of from providers is, hey, we're back to trend, maybe a little bit below, 5 to 10% below. That's still a very significant gap. But I think what hasn't happened, or it's only just begun to happen, is this element of the backlog and the deferrals coming back and sort of adding to trend plus and getting some outsized returns on that. There's also an element here where they're the low-cost provider, and there's been a lot of labor issues, as Emily just mentioned, but within the healthcare sector and labor generally has been tougher to get. They've actually done a pretty good job of continuing to open up stores and drive the volume. So the next slide on 33 here, you can see these two that I think are reasonably well related, just because it is more out of pocket, but using some data that is highly correlated on the vision side on corrective eyeglasses and contact lenses, which is a series that's sort of buried within the Bureau of Economic Analysis, personal consumption expenditure. We're just taking a reasonable expectation based on the prior period of like what trend should be. So it's been growing at X, it's going to continue to grow at X, and then summing the deltas between the actual and the trend line. That's where you get this sort of stacking effect of where we are, and you can see it sort of topping out here in the last couple of months through, I think the last data point is February on that. So what we're expecting to see, and I think what we already saw in Q4 is a percentage drawdown on that, in addition to these easing comps coming forward. It's a pretty simple model in terms of square footage growth and comp same store growth. So what we're modeling, which you can see on slide 34, just how they display it. What we're modeling here is and again, finding all this evidence around return to in-person care. This is a survey on from the CDC on slide 35, detailing, they have a very substantial, online survey out to, I think it's 50,000 people, asking in the last 4 weeks, have you deferred or delayed medical care of any kind? And you can see the percentage dropped, pretty materially from the 45% through the summer when COVID was sort of in abatement. It came back in the wintertime, and you can see just now as vaccines are starting to ramp, which is the other line there, both in terms of first dose and fully vaccinated, you can see it's breaking below that kind of 30% floor, which is a big number. And when we looked a little bit deeper on our own in our Hedgeye consumer survey, which we've been running sort of on a quarterly basis, asking about things like prescription drugs, telemedicine use, and a number of other things. One of the questions we slotted in this last time was, once I'm vaccinated for COVID-19, I plan to X. And if you sum up, if all the folks in our survey here who answered affirmatively to one or multiple of these, it came to about 40%. And you can see it's about 20%, 25% for I'm going to go see my eye doctor, which is a big one. So I think, again, people have been deferring, delaying. There's a lot of evidence that suggests that there's good growth ahead. In terms of that BEA number, one of the things you can see here in the last couple of months is that it's picking up. There's also this other data set that we uncovered in the CDC. They have this mobility tracker on their CDC COVID tracker. If you take a couple of clicks through, you can get to the underlying, and this is a visit index to offices up to optometrists. It doesn't line up super well, but you can see a couple of things. One is the weather, I think, that hit things in January, February. and the sort of recent uptick through the months of March, et cetera. We're going to be keeping a closer eye on that too, just because it is a daily series. It's going to give us a higher frequency measure in terms of what we're looking for. The other thing to call out here too is that the percentage change on a sequential basis is actually positive, Q4 to Q1. That's notable because the revenue estimates sequentially Q4 to Q1 on the consensus are actually negative. The last piece is, again, just sort of building confidence intervals around, okay, this is happening, it's not happening, it's happening now, or it's going to happen later. We run this machine learning algorithm, so the personal consumption expenditure data from BEA and a whole host of other time series that are related. We're basically doing a supervised machine learning algorithm that runs through and iterates and finds, without overfitting, a reasonably good proxy for what comes next. And we can do this with incomplete data for the current quarter. And again, you can see here, the consensus is for down sales. I don't know if it's going to be this kind of level of increase on slide 38. We have this huge blowout in estimate changes because the underlying same store growth here is going to be this kind of explosive. But it's entirely possible. We have a lot of evidence suggests we've got pent-up demand, we've got data sets that say that things are accelerating, and then our super special algorithm looking like it's pointing to good upside on a sequential basis. Now, what's this all worth? This is always kind of the key point. We think, if you look at that 2022 sales box and the 2021 sales box, but it's really the 2022, I think, where this works best in terms of looking forward, particularly as you get through the middle of the year, people start rotating towards that 2022 number. I think we're going to be at the upper end, right? So towards the 2.4 rather than towards the middle. That could get you a stock well into the high 50s, into the 60s. I think that's a reasonable case. It's not Brian McGough-esque, but it's certainly worth it in terms of, I think, the weight of the evidence here pointing to significant upside in the shorter term. That's it.
Is that just it that you have? You have 8% short interest in the stock. You have very concentrated bulls. So you have, I'm not just talking about Vanguard. I'm talking about like people that are doing the real research, like JP Morgan Asset Management and Adage. Those two together, Adage 9% and JP Morgan's at 8%. You have this interesting contrast between the two. You have high short interest. I'm assuming there are some valuation experts out there who like to short the stock as it's quote unquote expensive on earnings or something like that. Is that true?
Well, look, we're using top line because that's the best correlation of the sales to the stock price. So if you look at the NTM estimates versus the share price, you basically end up, you want to pay attention to the sales. It's not really an EPS story. It's not really an EBITDA story. So I think from that point of view, and that's why we're focused on it here. When you see this kind of low single digit, EV to sales multiple range that we've got on this thing, it's like, well, what is really the difference between, what's a quarter point between friends? Well, it's $5 to $10, right?
Well,
so that's the so I think where people are doing their work on this, it does seem to me that there's a longer term. You can tell the demographic story in the back end. Okay, people are getting older. Older people wear glasses more often than they wear contact lenses. The acceleration story, the consolidation story. There's a lot of deeper elements that can get woven into a narrative. If estimates are going up.
Well, it's very typical of a stock, as you know, Tom. When something is accelerating on the top line and it trades on the top line, it goes to a new high, like this stock did. And like a lot of small caps, it has recently corrected. And during corrections, professional investors either buy throughout that consolidation period to set up for the next set of highs. If it hits where you said it's going to make new highs. Or they freak out and panic and sell on a day like today. So pick your spot. This is the pitch. Tom just gave you the call. I know what I'm going to do with this when it's at the low end of the range, and it's getting pretty close today. All right. Thank you for that, Tom Tobin. Great idea. $4 billion company, obviously a small cap. Josh Steiner, a.k.a. the Stein Bomber. You didn't put on any Stein Bomber type gear, but we're happy to have you. Welcome back.
Thank you. Thanks. So, about 3 months ago, I guess late January, we did the pitch and we put up maybe the world's most boring company called Fiserv, which is a big payment processing company.
And it worked.
Focused on merchant acquiring. But since then, the stock's up about 20%. And
you're not going to pitch it again, are you?
No. But I am going to pitch another payment company that's also a merchant acquirer, this time a small cap as opposed to a large cap. But I wanted to sort of set the tone and tenor there because I think, Brian McGough's a tough act to follow. And when you're coming in with a very sleepy company that does payment processing for governments and nonprofits, it's a little tough to get people excited.
Paya instead of the PLBY. All right, I got it. Go for it.
So anyway, slide 42 is kind of a quick overview of some of the reasons that we like it. I'm not going to dwell too much here. We'll just sort of dive into it. But, bigger picture, you basically have a steady growth company operating in a segment of the payments market that is really kind of a sweet spot right now. It's the middle market. It's far less contested than either the enterprise scale or the small business segment. There's a really interesting M&A component to this story in both directions. So they're doing these great small tuck-in accretive acquisitions, but at the same time, the whole space is consolidating very rapidly. And we think that trend is going to continue over the next few years. So we'll get back to that in a minute. But first on slide 43, so what do these guys do? Basically, they're an integrated payments processing solution. That means that their real customers are middle market software companies. So they basically integrate their payment capabilities into the software platforms that are then sold to businesses. So they operate in really 5 sort of core markets. And these are all areas that are sort of a little off the beaten path in terms of what most payment companies are focused on. It's either the big enterprises or the individual consumer or the small businesses. And these guys kind of fill that sort of ether in between. So they deal with education platforms. They help governments, namely municipalities and small towns and very small cities, utilities, nonprofits, so faith-based, lots of charitable enterprises, healthcare, mostly like outpatient ambulatory, like dermatology, chiropractor, that sort of thing. And then their biggest business is B2B and services, and that's really sort of a focus on manufacturing and logistics. So these are all areas that are generally uncontested or far less contested. So they get a fair amount of opportunity there just from, by virtue of kind of being where the big guys aren't, so to speak. And a couple things to call out. One of the attractive characteristics of payments companies is the share of their business that's CNP or card not present. And Paya is actually one of the best on this front. 87% of their business is CNP. They also have very low attrition because that's kind of goes with being an integrated payments provider. Once you're literally woven into the software company's platform and then the business integrates that software platform, there is a very high switching cost associated with leaving that, changing. It makes the business very sticky, makes attrition very low. And so whereas most of the merchant acquiring space has annual attrition of around 15%, Paya's retention is about 92%, so only about 8% attrition, and then very low loss rates in their volume, less than 1 basis point. As a comparison, just to give people sort of a frame of reference on slide 44, Paya is in an interesting spot. Obviously, those businesses that we profiled, those lines of business, tend to be more defensive. So as you can see here, as a comparison to MasterCard and Visa in the second calendar quarter of last year, MasterCard's total volume was down 5.5% year over year. Visa is down 6.9%. Paya is down 2%. And then in the third and fourth quarters, Paya was up 7.5% and then almost 16% to MasterCard and Visa's 5% and 8%. So it's got a good, healthy underlying growth platform. In terms of where it stacks up relative to its peers, if you look at 45, this is just one framework for thinking about, whether something's, where is it relative to its sort of peer group. And on that score, both in the sort of 22 number and the 23 number, Paya is actually screening much more attractively than the rest of the entire group. And actually, you can see the one that screens the worst is one of our favorite ideas on the short side of firm. In terms of what it could be worth over time, slide 46, the approach we took was basically to think about both what the EV to adjusted EBITDA multiple is likely to look like in a few years, as well as what the company can compound its adjusted EBITDA at. And using fairly conservative estimates, we're getting to these types of numbers of $15 to $16 per share. And that's sort of a critical level for this company because it came public as a SPAC late last year. And there are really three trigger points on the stock where there's a lot of contingent dilution. And those, as we show in the top left of this slide, are $15, $17.5, and $18. But really the big points in that sort of $17.5 to $18 range. So we see very little resistance in the stock up to 15. At that point, you're going to get about 10 million shares of contingent dilution. And then, $17.50, $18, that's a really tricky level because then you're talking about almost an additional 30 million shares of potential dilution. But just getting to 15 to 16, that gives us upside of between 33 and 40%. And that's really over sort of like a year and a half timeline because we're talking about 23 numbers. And so by the time we're in late 22, people will be thinking about the 23 numbers. So roughly a year and a half. On the M&A front, as I mentioned at the beginning, so first, just to focus on what the company is doing, which is it's basically finding sort of niche payment platforms that are sort of logical tuck-in adjuncts to what they already do. So, for instance, their most recent deal was an acquisition of this company called the Payments Group. The Payments Group is basically has a turnkey utility or municipality processing capability. So it's really, just sort of out of the box. It works very well. And this is really for, small towns to be able to process things like property taxes and building permit fees and, pet fees and that sort of thing. And so they paid $21 million for it. And the company had an EBITDA run rate of 1.8 million. So they bought it for about 11 and a half times EBITDA. And they are trading at about 22 times EBITDA. So these are very accretive tuck-in deals. The company has done 3 in the last 18 months. The expectation is that they'll continue to do more. And now, obviously, being public, they have the currency to be able to do that more easily. But on the other side of things, this is also a space that has been rolling up at a very quick rate. So if we look back over the last year and a half, there were 3 major deals in the merchant acquiring space. So Fiserv merged with First Data, FIS merged with WorldPay, and Global Payments merged with TSYS. And now those companies are all basically sort of at the top. They, from an HHI standpoint, really can't consolidate any further. So now they're going to be looking to do smaller tuck-in deals in areas where they aren't. And one of the biggest areas where they all aren't is in this middle market. And so interestingly, along these lines, one of the most recent deals that was announced was Fiserv's acquisition of a company called Pineapple Payments. And that is a middle market integrated payments provider, which is very similar to what Paya does. And Paya plugs into Global Payments. That's how they do their back-end processing. Pineapple plugged into Fiserv. So it's not atypical for these smaller middle market platforms ultimately to be rolled up into their own back-end processor. And so in this case, that would be Global Payments. So we think there's a great growth profile here. It's trading very cheap relative to the group. It's in a segment of the market that is less contested, more defensive, but still has great growth profiles because the penetration rates are low. And ultimately, we think there are both opportunities to roll up accretive tuck-in deals and then ultimately very likely to be acquired themselves at a good premium. So we like Paya. It's boring, but it's good.
It's not boring from this price. It might have been boring at 14 or 14 and change. This thing had a rocket ship out of the gates. It came public, as you know, obviously in October. And it's also a good example of a concentrated ownership of active investors that are probably getting pumped right now on the small cap side. And this is a billion-dollar company that's just corrected 40%. So again, as you know, this is people sell due to risk management and liquidity issues in certain cases. And I would not be surprised whatsoever if that's why you're getting this stock right back at 10 again. So nice timing on picking your spots. Obviously, you're pushing this at 13 or 14 wouldn't be ideal relative to the price we have on sale today, my man. Thank you. looks a lot more exciting than he was giving me the impression it was going to be right out of the box here. Jay Van Sciver, are we connected? Are we plugged in? Are we bolted into the chair?
We are all of those things, and we have the PLBY of building products, so it's going to be amazing.
Oh, nice! I'm excited.
So we're gonna talk about AWI, which is a maker of ceiling tiles.
Yep.
If you think about, the standard product is the drop ceiling white tile, and that's a great business because when one of them gets dirty or scuffed, or you put a pencil through it, you replace it with the exact same tile at a very high margin. But I think this is a company that got baked in with the. If you look at the mix of businesses there on 51, you'll see the office is a big chunk of what they do. And obviously work from home fears and pandemic recovery concerns have been a big headwind for the stock. And I think it misses the far bigger pending catalyst, which is in fact infrastructure, which we can go through on the bullets on the next slide. The reality is that infrastructure is coming. It's going to be passed pretty much independent of bipartisan support or not. And it brings a lot of money to schools, transportation facilities, airports, things like that, healthcare facilities, federal buildings. And this is similar to what happened in the ARRA under Obama when Biden was vice president. And it did drive a lot of building products demand. That was a little more energy efficiency, air conditioning, HVAC systems. But this is a sizable, this is going to bring hundreds of billions of dollars of spending to a market that really needs the investment. People talk about infrastructure being old and underinvested in. And in fact, I think that's true. And the pandemic is actually going to result in new codes and higher, probably end the trend of less space per worker. It would be great if it ended the trend of less space per airline passenger. But certainly you'll see some of the prior trends reverse. And you'll have some very innovative products included in ceilings for ventilation and sterilization and things like that. So there's definitely this infrastructure plan is a trigger to deal with some of the deficient infrastructure and aging buildings that we have across the U.S. And I think that this is a company that divested some European operations, refocused on its core business, basically making things that don't look like drop ceilings anymore, putting in some interesting walls, paneling that looks like you're in a much nicer building than you would think you were in. So they have a lot of innovative products that are coming out, and they're also pushing into some residential applications. And when you do think about this business, we're saying 50% relative upside, but this is the kind of company at its size with the kind of market opportunity, multi-year expanding market that could be a multi-bagger. We don't have to go further than that. I'm not going to go out further. These are cyclicals, and we always want to be careful. But this is the kind of name that I think could be a long-term winner. It's also, as we think about the back half of the year, a pretty good quad 4 performer, right? So that's something we want to be mindful of as we enter a decelerating growth environment. We don't want to be in a bunch of deep cyclicals exiting this year. And I think one of the things that gets lost in the debate about what is infrastructure on the next page is just that this is the age. This is one of my favorite series is put out by the BEA, which is the age of everything. And we're going to do a deck with Neil Howe looking at infrastructure and sort of the demographics of the assets that are out there, right? So when these things are aging, right, that means that we're spending below replacement demand on maintenance and new structures, right? So you don't think about non-residential structures as aging in the U.S., but the reality is they are, and they're aging kind of like they did during the Depression. And that includes, office structures on the right. You can see on the next slide, highways and streets are actually aging quite rapidly. A lot of this kicks off with the financial crisis, but you can also see a little history in there. You can see the highway, the interstate highway system is where it declines into the late 1960s, and you can see obviously I think residential housing has been an area that's been recognized as being below replacement demand investment. And we can look at a completely different data set here, which is square footage per capita added per year, which is showing something very similar, that basically construction never recovered from the financial crisis. And it's really fun on the right. Like when we later do this thing with Neil, you'll see like the black line on the right is education. You can see the baby boom and the boom, the echo boom or whatever it is. That's Neil's territory. But you can see like by category when, we add a lot of manufacturing capacity for World War II. There's all these sort of interesting historical trends that are reflected in the data. But what's very clear is that we are not building at a pace that is consistent with what we are basically using up. We're building below replacement demand. And, right now, if we go to sort of the next slide, we are in a weaker market. Even though prices for building products are spiking on the right, where non-residential construction is actually quite weak. And usually that's a good thing in cyclicals. Usually you want to, it's like opposite day. Like you don't want to buy peak data and you don't want to short trough data, right? The data is, basically spending is weak through the first quarter, accelerates into the back half. As we get through reopening, think about venues that will, require, replacement ceiling tiles, like the dentist office that I went to that was pretty horrific, or places that have storm damage in Texas or Louisiana or whatnot. So I think this starts to inflect. Reopening is a big positive, and insofar as there's deferred activity, tax credits, other construction activity tends to bring along, with the government infrastructure spending, delayed projects will come, on stream. We'll see a lot of consumption of material. And we're already seeing a lot of it. You can already see some of that in lumber. Next slide. These are some of the products. If you think about a drop ceiling, these are much more architecturally significant products that are out there now, particularly, they look more like, fine institutions or whatever. They look pretty good. And in particular, the drop ceiling insert on the left there is something to remove, basically bacteria, mold, and viruses from the air and increase circulation in schools, universities, hospitals. That just slots in without a lot of like new infrastructure or equipment. It just drops into the ceiling and creates additional ventilation and cleaning. Looking at like the scale of the infrastructure spending that's proposed by the Biden administration, it's really noteworthy how much they're putting to work here. If you look at the schools, you're talking about a market that's maybe going to spend $60 billion in total construction this year. You're talking about a big, it actually ends up being about $100 billion incremental spend into that market, particularly on things that impact an AWI. And that's just one category before you get to healthcare, before you get to federal buildings, VA. There's a lot of, even the residential applications there are very significant. So just kind of to wrap it up, the U.S. has significantly underspent on infrastructure for a long time. And just the normalization of that is tailwind. If we just stopped letting everything age, forget about fixing it, just stop letting streets, roads, bridges, non-residential structures, whatnot age, stop the aging. That's a big boost in spending just to get there. When you throw on infrastructure on top of it, it's a significant multi-year market for a company like AWI. And I think that visibility could really result, especially since this is going to be something like a 10-year plan, is going to allow AWI to re-rate, to basically, as you've seen in some of the aggregates and cement names, basically a premium valuation and outperform over a long period of time. I think there's also just the reopening aspect to this, the idea that some workers will certainly be back in the office. I hope to be back in the Hedgeye office, and we worked from home before that, and I still have a desk. So it is I think a significant catalyst along all three of those dynamics that we look for: long cycle, the nearer term catalyst with reopening, and basically just finding a structurally excellent business with high margins and high returns.
There's certainly scarcity value associated with something like that. It's interesting, too, not every small cap stock looks the same. I mean, this stock has not gone down. I mean, this has been an excellent call for a lot of reasons. I've mentioned a couple of them. When a shareholder list is decorated with shorter term hedge funds, you have to be more careful. When high short interest is there, there's another factor. This one has low short interest. Basically, T. Rowe and Capital Group together own almost a third of the stock. And, pre-COVID, it was at $110 a share. So, it's an interesting one, and that's pre-infrastructure, everything else that you've already addressed. So, these kinds of ideas, we can't just paint the tape with everything that's small cap, it goes down, or every SPAC goes down, blah, 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 blah. These are the times where you should differentiate, within the portfolio. And these types of ideas, we did have a lot of smaller cap type names. This one's $4 billion, I believe, in cap. But another really good idea brought to you by the Jay Van Sciver, the one and only Jay Van Sciver, who is also in short supply. That's what we want to be long of things that are in short supply, like great analysts. So thank you very much for joining us on The Pitch. Those are 6 ideas in 60 minutes, and we'll see you next time.